Good afternoon. My name is Salima, and I will be your conference operator today. At this time, I would like to welcome everyone to the Global Monetary Policy Outlook for 2016. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. Thank you. I will now turn today's conference call over to Mr. John Skinner. Please go ahead, sir.
Thank you, Salima. Welcome, everyone. This is our last program of the year. This is also our second ever conference call. My name is John Skinner. I'm VP of Programs for ASFIP. And since this is kind of a new thing for us, I definitely welcome your feedback. Kathy will be sending around a survey to all the participants later. If you wouldn't mind, please take the time to respond to that. I just want to know how to improve this going forward. Everyone should have gotten some materials by email yesterday from Kathy around 8:16 a.m. So if you can check your email and find the materials, there should be 3 attachments. So the email sent yesterday at 8:16 a.m. from Kathy. The call today should be a timely topic, global monetary policy. We realize it's not the only call going on today on monetary policy, but we hope it's the best. We also hope that it's more timeless because this call will be recorded and posted to our website, so it should remain relevant through at least next year. The intent here is, we'll address what's going on today and tomorrow, but quickly, hopefully, move past into 2016, and also more in general, just about how to forecast central banks. Today's call is being recorded, and so I hope to post that quickly to our website. I hope you'll access that there, along with all the rest of our content you can find on YouTube. And we're quickly trying to develop other ways for everyone to access audio content online. Our guest today is Steve Malin, Director, Investment Strategist for Allianz Global Investors. He is responsible for quite a few things, in addition, analyzing global economic, financial, political, and regulatory developments. He has 24 years of financial markets, central bank, and investment industry experience. He has prior experience at Wealthstream Advisors, Aronson Johnson Ortiz, AllianceBernstein, and the Federal Reserve Bank of New York. He has a BA in economics from Queens College and a PhD in economics from the Graduate Center of City University of New York. Welcome, Steve.
Thank you very much. It's a great privilege to be with you. And before I begin, please allow me to wish everybody on the call very, very happy holidays, and may the year ahead be everything that you want it to be. Well, we're sitting today at the precipice of what looks to be one of the most major changes in monetary policy regimes, really, of the past 100 years. Never before has there been so much emphasis on what the Federal Reserve is going to do and what its implications will mean around the world. What I would like to do is put into context for you some of what might be going on at the meeting that commenced today at the Board of Governors and ends at 2 p.m. tomorrow with the release of the statement and then followed by Janet Yellen's press conference. Before I begin, just let me make sure that you understand that what we're seeing today in terms of monetary policy decisions is taking place in an environment that has changed in just the last 3 or 4 weeks. Not enough to change the decision, just enough to change the environment in which it's taking place. In just the last 3 or 4 weeks, we were reminded of a few things that really normally have a significant impact on monetary policy, but won't this time around. First of all, the issues going on in the high-yield market are very important. They are a signal to us of the vulnerability to liquidity shortages of a market that is trading in securities that themselves may be illiquid, a market that is being increasingly dominated by ETFs, which themselves have liquidity issues, and a market which is part of not quite the shadow banking and shadow financial system, but something which is new and emerging and growing. It's a market that was taking advantage of the desire of investors to maximize total return in an environment of very low interest rates and low yields. Some of this is going to change with the Fed's decision. So one thing to keep in mind is that this could be something of a canary in a coal mine. But what it's exactly telling us, we don't know, because the markets in general are not illiquid. This particular firm was illiquid. This particular fund was illiquid. These particular securities were illiquid. What we're watching now is to see the extent to which this is something that is spread across the high yield market. From a central banking perspective, this is really important. If you were to ask any central banker what's the single biggest thing that might cause you to lose sleep at night, it's not inflation or deflation, it's not economic growth, it's the stability and the functioning of the financial system as highlighted by its liquidity. What central bankers cannot tolerate is markets that become so illiquid that they start to seize up. That's what we saw under different circumstances in 2008. It's what we saw momentarily on a number of occasions in 2011 and on 10 different occasions in 2015, where market liquidity disappeared temporarily and then sort of shot right back up. What you can be sure the Fed is watching and central banks around the world are watching is whether or not the problems at the Third Avenue Fund are indicative of a problem in the high yield market in particular, and whether or not that's saying something about the growing influence of ETFs that will just complicate monetary policy going forward. That's a major change. Number two, we've seen some changes in the currency markets. The dollar was on a rapid and fairly sustained movement upward against major currencies around the world, and that has suddenly stopped. And it's ironic that it stops at a time when U.S. interest rates are diverging, potentially tomorrow, from those in the rest of the world. What that's telling us is a few things, and some of these are really quite positive. What it's telling us, perhaps, is not that there's any problem with the U.S. that currency markets are responding to, but that they're growing increasingly interested in the positives taking place in Europe and Japan. That, in fact, the Japanese yen and the euro are starting to look more desirable because things are starting to look more desirable in Japan and in Europe, something for us to watch. A month ago, we weren't talking about that. The third thing to keep in mind is that for all of this speculation about what the Fed will announce at 2 p.m. tomorrow, keep in mind that the markets have been relatively mute. There have been some small visceral responses to various things that Federal Reserve Bank presidents have said in particular, some hints of what Janet Yellen may have said in testimony and speeches. For the most part, though, the markets have been relatively mute. In fact, as you look at the money markets today, they're operating very normally. You have not yet seen a spike in the federal funds rate, even though the speculation is that it's going to move to a base of 25 to 50 basis points. You just haven't seen that. And so as you look out at the markets, we have to decipher whether or not the markets have grown maybe painfully complacent, which is a possibility, or whether the markets are behaving in an orderly fashion, which is a very favorable thing. We will find out tomorrow and the days after when we look to see whether markets in the U.S. and around the world are behaving in an orderly fashion, where there can be price discovery, where you can find counterparties, where the volatility could spike up and then spike back down again and the markets can become orderly. A month ago, we were not talking about these issues. We're talking about them now. So to sort of put this in perspective for you very quickly, the Federal Reserve really could not move at its previous two meetings in September and October because they had told us what the conditions were under which they would make a move, and those conditions had not been met. One condition was that they needed absolute confidence that their tool set, the approaches that they're going to take to keep the federal funds rate within its new target range that is likely to be announced tomorrow, whether that tool set is going to work. They had been testing it since 2011. They're now at a point where they believe it will work. So you could put a gold star next to that one. Then it gets a little more complicated. They had to be sure that the financial system could tolerate all kinds of financial and economic conditions, but they needed to have some confidence that the markets would react in an orderly fashion around the world once the announcement is actually made. We forget sometimes when we think about the outlook for central bank policy that they are indeed a central bank. They are not just a monetary authority, and therefore they are looking very carefully at what is happening to the functioning of the financial system. Back in September, we had tremendous disorderliness in the Chinese financial markets in particular. And in an environment like that, it gives a central banker pause. So that's another condition to look at. There was no green light there. Another condition to keep in mind is whether or not they have hit their inflation target. And as of September, they had not. And while it looks like they're creeping toward it, they still may not have hit their inflation target. What you can look for in the statement tomorrow is some statement of confidence that they believe that even though the inflation target has not really been hit, we're moving in the right direction. Put a gold star next to that one. Another condition, has there been sufficient slack taken out of the labor market? Well, this is one you get a gold star because the labor market is actually tightening pretty nicely, and we're starting to see some early signs that wage growth is starting to pick up a little bit, and that's a positive. So you put this all together, there's a bunch of regulatory and supervisory issues, in other words, issues looking at the stability and the functioning of financial markets. They're looking at their tool set. They're looking at how inflation is performing. They're looking at how unemployment and employment are performing. And when it was all said and done, as we sit here in mid-December, it's starting to look like their conditions have been met. And that's why we at Allianz Global Investors believe that they're going to make their move tomorrow. For them not to move would create an issue for them. They've told us the conditions. They've met the conditions. They have to move. Importantly, central banks around the world are thinking in very much the same way. When you listen to and read the speeches by Mario Draghi, for example, they sound very much like the same kinds of things that Janet Yellen talks about, except, of course, he's talking about the Eurozone. So central bankers around the world who meet the first Monday of every month in Basel, Switzerland, all of the G30 countries, so it's a big group that meets the first Monday of every month, they get together and they share ideas, and now they're all sharing perspectives and strategies. So when you look at central banking policy around the world and what Mario Draghi is likely to propose to the rest of the European Central Bank, it's very much the same kinds of criteria that Janet Yellen and the Fed are looking at. And that would be a good way of thinking about when the European Central Bank may start to reduce some of its accommodative policy. So in this environment, central banking takes on a role which goes beyond monetary policy and looks at things that are on the supervisory side as well. So they're looking, for example, I'm sure today, at what transpired with the Third Avenue Fund, and they're asking whether or not that says anything at all about a systemic risk, a risk that could spill over to other companies and funds, even to other parts of the world. They will be monitoring that carefully because the liquidity of the markets is critical to the functioning of the central bank. One thing we know, if you're going to predict what central banks will do, is that they are relatively patient, but when they act, they must act forcefully. Which leads us really to one last point. As we proceed through 2016, keep your eye on the inflation rate. Right now, the issues are disinflation and maybe even deflation in parts of the economy. But make no mistake about it, the low oil prices will either settle down or they'll start to come back up again. And the effects of the very loose monetary policy over many years are going to start to take hold. This always happens with a lag. And if it starts to hit in 2016, make no mistake about it, the Fed will react vigorously, and that means they'll move faster to raise rates. They'll move bigger in terms of raising rates. If inflation starts to pull back again, make no mistake about it, they will pull back also. They will either pause or even consider starting to lower rates. Keep your eye on the inflation rate going back. So as we look at the outlook for the markets in 2016, we would ask you to think about 5 or 6 different terms that sort of summarize where our views are going. First, we have absolutely no doubt that there's going to be more volatility in markets pretty much across the board. So one thing to watch is volatility, whether you measure it from the VIX index or any other way. The markets are going to be more volatile. They have to be, because they're going to be adjusting to a brand new interest rate regime, one where the outlook is for rates to rise and not fall, one where the shape of the yield curve is going to change, where it's likely to be moving up a little bit, may even flatten on the long end. We don't know yet. But one thing is that it's got to yield a lot of volatility. Where you want to be careful is where the volatility becomes disorderly. And again, disorderliness means the markets are behaving in a one-way fashion. Everybody is looking to sell or buy. Everybody wants puts and no calls, or all calls and no puts. You can't do price discovery out there. You can't find counterparties. If we start to get disorderliness in the markets, look for the central banks, particularly the Fed, to act very forcefully and very quickly. So first term is watch volatility. The second thing is watch correlations. One of the things that's happening is that markets over the past several years have been generally moving in the same directions, either risk on or risk off, in response to some news of some sort or some other stimulus. We think in 2016 the correlations are going to drop. And as the correlations drop, it's going to be less so of markets moving in one direction, risk on or risk off. That means that excellence is going to prevail. Companies that are good from a value perspective, companies that may have been beaten down for no reason other than they're in the wrong sector, for example, are going to start to separate from the crowd and become very attractive. So this is going to be a great environment for active management. Third word is divergence. There's divergence all over the place. Look, the developed market world is doing very well by comparison with what's happening in the emerging market world. One divergence. The service industries are seeing much more rapid inflation and growth in the U.S. than are the manufacturing industries. You see divergence between the Fed and other central banks. The Fed is starting to raise interest rates. Other central banks remain very loose. That divergence gives you an opportunity to start to be much more selective in terms of the kinds of securities that you own and the funds that you own, because a rising tide will not lift boats and a falling tide will not drop them. Consistent with that is the fourth term, and that is dispersion. There's going to be an awful lot of dispersion going on, and dispersion really means that you're just going to see a lot of different outcomes in a lot of different ways. All markets will not move in the same direction around the world. You're starting to look at a situation where, at least over the near term, the developed market economies are much more appealing in certain ways than some of the developed market economies, at least until commodity prices start to rise. The fifth one may be the most important one of all, and that is you're into a pattern in 2016 where you're going to be seeing much more reversion to the mean. Think about it for a minute. How many different markets are so out of whack? Interest rates near zero. Some equity markets at historic high PE ratios. The Chinese market, where you saw dramatic increases in valuations, followed by dramatic drops in valuations, followed by dramatic increases, followed by dramatic drops again. What's going to happen is any number of different markets are going to start to normalize. You know, we're sort of on the doorstep of change, knocking on an entry into something more normal. If the Fed gets this right, markets are going to normalize. But what that means is that some are going to be going up and some are going to be going down. And so watch the markets that are mispriced because of the circumstances of the ultra-loose monetary policy and low interest rates. They're going to revert to the mean. And that tells you pay attention to fundamentals. Those securities, those companies that have great free cash flow and strong balance sheets are likely to have a very good year in an environment where you've got much more dispersion going on. A final thought for you, which is about the economy. The U.S. economy is on a pretty good run. We're growing at a relatively slow pace, in part because productivity gains in the U.S. are relatively slow. And yet, when you look at a lot of aspects of the U.S. economy, there's really remarkable strength. The strength in the U.S. economy right now is going to be in the areas that are associated with services. And that's because manufacturing continues to suffer from the strong dollar. If the dollar normalizes, if the dollar loses some of its strength, manufacturing will come back. For now, we are a service-dominated economy, and that has some echoes of a different era, like in the 1980s, where people were talking about a bi-coastal U.S. economy, where the West Coast and the East Coast were doing well. But what it says is, if you're going to increasingly be an economy that's going to grow that way, it's going to be an economy that's going to have not fantastic output per hour, that's productivity, fantastic outcomes per hour. Now, specifically what that means is, even though from a value perspective, 2016 looks like a year that could be very, very positive, it means that it's an environment in which a lot of the trends in technology and trends that have to do with demographics and other factors that have nothing at all to do with the business cycle are going to prevail. And so what we've been talking about is, hey, pay attention to the outlook for 2016 from a value perspective, but also pay attention to very, very long-term trends in things like healthcare, energy, computer platforms and algorithms, technologies like robotics, things that are related to the environment, and demographics. It forms a nice little mnemonic, which is HEATED, healthcare, energy, algorithms, technology, environmentalism, and demographics. Those things are not going away. And if we learned anything from the performance of the stock market in 2016, is that the winners in those groups do extremely well. Another thing that calls for active management. So if you look at it and you look at how much of the growth, say in the S&P 500 in 2015, was captured in really only 8 companies, you look at that and you say, wow, if you can identify the leaders in each one of those HEATED sectors, it's got a real possibility of making substantial gains. So to sum up, we think the U.S. economy is going to grow in 2016 at a rate roughly comparable to where we were in 2015, which is in the area of 2.5%. We still think that you're not going to see great productivity growth, but that doesn't mean that this economy isn't becoming more efficient, because it is. And as it becomes more efficient, you have a greater likelihood that the earnings disappointments that we've seen over the past 6 months are going to reverse, and you'll start to see better earnings numbers. The issue is going to continue to be whether you see top-line growth, because there's very little pricing power. But even with that, we're forecasting a little bit more inflation in 2016. And as we know, if you get more pricing power in a strengthening economy, you should see revenue growth. So we think it's going to be a little bit better year. Stock market itself, we're not forecasting that it's going to move up terribly much from current levels. But what we do see is more dispersion. The winners are going to be very good, and those that fall away are going to have a tough year. That's what dispersion is all about. So we think the economy is going to be doing better. Look for manufacturing to continue to have problems as long as the dollar continues to be in many ways overvalued. But that, having said that, if in fact the U.S. consumer continues to show signs of increasing use of credit with rising wages, you might see an environment where for the very first time since the financial crisis, companies have an incentive to expand capacity not through M&A, but by buying actual equipment. And so we may, for the first time in 2016, start to see sales of industrial equipment starting to get a very solid footing. So in terms of the U.S. economy, we have sort of a tepid, but certainly not a pessimistic outlook. In terms of the European economy, we see more acceleration of growth. In simple language, we see them not just on their feet, but actually now starting to walk at a pretty rapid pace in 2016. That might be part of the reason why Draghi was not as aggressive a couple of weeks ago as some of the markets had anticipated. Didn't think he needed to be. It's still worth watching. There are huge issues with the European economy, and now they have the overlay of the immigrant problem, which they're going to have to finance somehow to feed and house and clothe and educate, etc., all the people who have come into Europe. That having been said, we believe that Europe is doing better. And we're also looking for China and Japan to do better. China, because they've put in place a lot of policies that take time to unwind, and while it's likely to be another choppy year for China, I think that they're starting to get back onto their footing as they convert their economy away from exports and manufacturing and infrastructure. And Japan, we're hopeful that monetary policy that works with a lag will finally mean that that lag is coming to an end, and you'll start to see the benefits of what has been some of the most aggressive monetary and fiscal policy in the world. So in general, with the exception of commodity exporting countries, particularly in the emerging market world, we think 2016 can be a bit better than 2015, and we're hopeful that that will generate some significant gains in the markets. As for the equities markets, as I said, we're looking for better earnings probably beginning in the first half of 2016 when there's more pricing power. In the fixed income markets, we're looking for the yield curve to move up a little bit, but to flatten, and not inconceivable that you could end up with a portion that temporarily might actually invert. So we're watching that very carefully. And with that, I will end. I'd be happy to take your questions.
All right, Salima, if you could open up for questions.
If you would like to ask a question at this time, simply press star, then the number 1 on your telephone keypad. Again, to ask a question, please press star 1 at this time.
All right, thanks, Steve. And while we wait for questions to gather, I'd like everyone to kind of pull up the forecast survey, our ASFIP forecast survey results. That's in Kathy's email. It's a file called ASFIP 2016 Forecast Survey as PDF. As you can see, Steve, we have a pretty tight band around many of our forecasts, but in terms of Fed funds, it's very wide. I mean, you got everywhere from -0.25 to 1.5, and they're pretty evenly distributed throughout all this. And so I know that you guys are forecasting something towards the higher end of that range. I think I got a number from you guys at 1.25 to 1.5. So first of all, I'd like you to tell us what we're getting wrong, but also, is this wide range something that you're seeing across the street, or is this something you think may be unique to us, or what are you guys thinking in terms of the uncertainty around the Fed funds rate?
We have been seeing a wider range of forecasts for a lot of different things, and the numbers that are on your on your summary results are not surprising to me. As we look at it, we're anticipating, as I said, that the U.S. economy is going to continue to grow, not bullishly, but at roughly its potential rate, which for the U.S. is 2 to 2.5%. We're looking at this and anticipating, as I said, that inflation is going to go a little higher. Our forecast is based on a notion that the Fed is going to move tomorrow, and then all bets are off as to when they move again. We think that they're likely to move 2 or 3 times roughly 3 times, maybe even 4 in 2016, but it's going to depend on a lot of things that are moving targets. Is the economy going to continue to grow? Are the markets going to be stable? Are there going to be liquidity issues in certain markets? There's so much that's unknown that it's very hard to have a very high conviction forecast, but we have to produce some forecast, and that's the one you alluded to. It doesn't surprise me to see somebody who thinks that the Fed funds rate could be minus 25 basis points. That's effectively a forecast that says the Fed starts to move, the economy starts to tank, the manufacturing issues in the U.S. become more intense, and effectively what you're looking at is a circumstance where the Fed very quickly has to reverse field. I would say unlikely, but certainly not impossible. So effectively, just to answer your question, it's really hard to get your arms around this until and unless you have a clear view for what the conditions are that the Fed is looking at. Will the financial markets be stable and orderly? Will the banks be passing their stress tests around all the way around the next time they're given? Will we be seeing a situation where inflation is starting to accelerate or decelerate? Some of this has to do with the forecast for the price of oil, which, again, your range goes from 36 to 96. We're somewhere in the middle of that. But what happens to the price of oil? Does that become deflationary around the world? Do you start to see a circumstance where you end up with a geopolitical risk that stops investment, that forces the destruction of infrastructure? All of these things are sitting out there, and we don't really have answers for them. So as you look out a year ahead, you have to just rely on what you know central banks, particularly the Fed, react to. Inflation, we do think that they're going to keep inflation in the 2% area. Slack being removed from the labor market, not as quickly as it did in 2015. We're not going to be getting months ahead where we're going to be getting 275,000 jobs, over a 2 or 3 month period. That's not likely. But we might continue to add them as the economy stabilizes. And if the financial system stays solid, it behaves in an orderly fashion, and the liquidity issues that we're seeing now around the fringes of the markets, and you get a lot of anecdotally by talking to traders, if that becomes worse, then it changes the entire outlook, and they have to be more cautious.
Yeah, it's funny. Our first conference call, this being the second, the first one focused on bond market liquidity. Funny enough. Do we have any questions?
There are no questions at this time.
All right, I'll give you one more and see if we can generate some questions. If not, we'll let you go. The next one would be, at one of our recent events, we had a portfolio manager tell us that the thing we needed to become experts in is Chinese central bank policy. And so I wanted to know if you had any opinions on Chinese central bank policy, and also what is different about their central bank, and what's different in terms of how we should watch it?
There are some tremendous differences. First of all, they're operating in a very different system in which they've got somewhat free markets, but largely markets that are controlled by the government. Keep in mind that Premier Xi is the most powerful leader China has had since Mao, and that, make no mistake about it, his party loyalty and the demands that those who work with him, whether they're in the central bank or the provincial governors or whomever, he makes sure that he's got his folks in power so that he can execute things that just couldn't be done in a free market. Number two, China has very different intentions from its central bank in certain ways than we have from ours. It's very different coming off of a global financial crisis like we were in compared to what the Chinese are doing, which is the very difficult task of taking a very rapidly growing economy and slowing it down to a soft landing. That's very difficult to do. In the process of doing that, the tool set that they're using is not nearly as sophisticated as that which the European Central Bank and the Fed in particular have. Manipulating something like the reserve requirement is simply not as effective as some of the tools that the Fed uses. Number three, they show a much stronger penchant for the central government to impose very, very strict regulatory controls over markets. You know, one of the things they did was they tried to convert their markets from one which investors were focusing on real estate to one where investors were focusing on equities. And in doing that, they opened up the floodgate to margin borrowing. So margin borrowing and lending in Japan and China just shot off the map and became very perilous. Well, when that became apparent and you started getting margin calls during the summer, they clamped down, and as you know, they put trading restrictions onto their equities markets. Well, in all of this environment, you've got a central bank that's trying to keep the market steady while at the same time doing something else which is very, very significant. First of all, they wanted to be sure that the RMB, the renminbi, would become a reserve currency around the world. So they somewhat liberalized their markets to assuage the IMF. The next thing that they did was try to maintain some sort of sense that China would be the focal point of finance and economics in Asia. And what they did just within the past few days was to effectively say, well, we no longer have even a loose peg to the dollar. We're now pegging to some basket of Asian currencies. Their goal is to tear down the Bretton Woods system from 1944, which effectively made the UK and the US the global centerpieces of economics and finance. What they want to be is the equivalent of that in Asia. So when you put it all together, they don't have the same tool set. They have very different goals. They have a much more heavy hand of government involved. They have markets that could be manipulated much more profoundly, like the cessation of trading, by the central government. It makes the central banking environment very different. And finally, and this is also pretty important, they're really smart. They've been doing some things that are really, really smart. But make no mistake about it, they're also relatively inexperienced. They've been only at this, in the area of a quarter of a century. They're still learning how to do this. And so one of the things that we anticipated and in fact got in 2015 was that they would make a lot of moves, which they did. They cut the reserve requirement or changed the reserve requirement 8 different times. By comparison, by the way, the U.S. has not changed its reserve requirement since 1992. They did that 8 times. But that's their basic tool, so it may be an unfair comparison. They're going to make a lot of moves, and they're going to make a lot of mistakes because they're sort of learning on the fly. So our sense is that as central bankers, they're very smart. In a way, they're very courageous because they make a lot of moves. But that heavy hand of government in the functioning of their central bank is something that is not akin to what you see in Japan, to the least extent in the Eurozone, and certainly with the Fed.
Thank you, Steve. We'll check one more time. Are there any questions in the queue?
There are no questions in queue.
Okie doke. We'll call that one then, and thank you, Steve, for coming and enlightening us on monetary policy. Everyone else, I hope to see you guys in the start of the new year. First event, our live event of the new year, will be a fundraiser at Vino Venue for our new foundation. We just established a foundation and hope that everyone considers that as a place to give as the year comes to a close. Again, thank you, Steve, and we'll see everyone soon. Thank you.
You're very welcome. Thank you.
Thank you. This will conclude today's conference call. You may now disconnect your lines.